does it matter what form, what shape the stimulus is, or is it just stimulus passes, markets get a green light?
Yeah, well, there's going to be stimulus. Whether it happens before the election or not, it doesn't. I mean, it almost doesn't matter, because I think the markets are much more long range in their thinking. I mean, we see daily volatility. But our base case is there's going to be stimulus, regardless of who gets elected, regardless of the way that the Senate goes. There's going to be stimulus because at the end of the day, this is a problem of bridging us from where we are today with the virus to where we're going to be once there's effective therapeutics and vaccines. And so once those things happen and we can cure the health thing and people can go back to some semblance of normal, we have to make sure that people continue to have cash and spend in order to keep things afloat. And so I think that's really at the center of it. That's why we believe, regardless of who gets elected, there's going to be stimulus.
So do the markets, in your view, have a green light to rally till year end, Jeff? And I'm asking you this with the notion that if you take a look at the volatility curve, I mean, it's flattened quite a bit going out into the future, whereas before a premium was much higher in November and December, which seemed to imply that markets were pricing in a contested election. Now, with Biden having a more decisive lead in the polls, that seems to have gone away. So is the market consensus now flipped to blue wave or Biden presidency is a good thing?
Well, I think the markets just are flipping to the idea that any certainty around the outcome of the election is a good thing. I do think a blue wave is not a bad thing. I think there's a narrative out there that maybe it is a bad thing because of taxes. But I would just say in a blue wave, there's going to be so much stimulus. Any increase in taxes to pay for that is going to be washed away by the amount of stimulus that happens. So the market kind of gets that, and at the end of the day, probably prices that in. As it relates to rallying through the end of the year, we've been pretty convinced it's going to be range bound. I mean, it could be up or down 5% from here. Again, assuming that we don't have some sort of surprises that happen, though. It's par for the course. In 2020, if you were to look at 2020, the outcomes in 2020 with as many left tail and right tail events as we've had in 2020, it's hard to be predictive. But our base case analysis is that the market hangs in there and is range bound in and around these levels between now and the election, barring some unforeseen, exogenous event that occurs.
Hey, Jeff, we've heard a lot of research desks changing their Q4 forecasts on the premise of no further fiscal stimulus. But I wonder, ahead of bank earnings next week, what's happening right now at the banks as they try to figure out whether or not loss provisions are going to be a story again after they were in Q3 or Q2 and Q1?
Well, I think the big banks have to think about taking loss provisions, and they can probably afford to do that because trading has been really strong. Capital markets financing business has been really strong. And so there's an opportunity there for them to take a portion of the profits they have and reserve against losses in their loan books. That's what I expect to see. I mean, it's been pretty bananas in terms of the amount of companies that have raised money across the sector. The Fed has been a real friend of the banks here for the last 7 months. And I would say, whether they're hosing down the runway or just providing their own monetary stimulus package, it's really caused a lot of companies to go out and do a lot of financing. And that's been great for the banks in terms of their operating businesses. So I would expect to see an increase in loan loss reserves. But I actually think the banks are going to continue to make money here because it's been that strong.
Shepard Smith here. Thanks for watching CNBC on YouTube.